Thank you very much, Ming Soong. I really enjoyed your remarks very much, and I think this point you made about dependence on the regulator and being driven by the regulator is, I think, a great challenge in many banking systems in the region, because capability is being built, and there is a great deal of wisdom in the regulatory system globally, at the Bank for International Settlements, at the Financial Stability Institute, and so on. So I think it's quite natural that supervisors around the region will draw from that body of knowledge and wisdom, and that banks would naturally look for that guidance as they're building their own capabilities. So the question is, at what point in the evolution, in the risk management journey, if you will, do banks stand up on their own feet and, as you say, think for ourselves what works, what's going to work well for us? I think that's a question that everybody has to confront.
Okay, I think that's a difficult question to answer. I speak for the UOB experience. I had the benefit of having worked as a regulator for a couple of years, and the benefit of having a better understanding of public policy, social impact. And when I came into UOB, the first even before I came into UOB, the first question I asked when I was with the MAS is, do regulators take risks? And at some point, people were saying to me, you're going to be nuts. We're regulators. We don't take risks. Then when I went into the bank, I said, well, do risk managers take risks? What's the risk to me as a CRO if I had followed a set of regulatory requirements? I said, tick every little box. I said, yes, I've done this, and I should be fine. And yet, there is a probability that I could blow up as an organization. Now, who am I going to stick that finger to? I draw from my experience as when I was trading when I was trading many years ago, as a young trader. I was still trying to come to grips with the marketplace, and we used to pick up the phone, call our buddies, and say, hey, what do you think of the market? And we take positions on that. And some days you blow up. And so what do? Do you blame the guy who gave you the information, or do you blame the guy who took the decision yourself? So I'm the sort of person who say, look, I'd rather take the decision independently, and if I fail, I'm just going to look at myself. Right? I guess at the end of the day, the important thing also, I think more pragmatic as well, is that if we take a decision to say, build a model in a certain manner, the regulator comes in, do an assessment, it's easier for us to defend why we did what we did, right? Rather than telling the regulator, hey, I just follow what you said I should do.
Thank you. At this moment, I'd like to invite Jason George to offer some comments and reflections, and perhaps pose a question or two to our speakers. As most of you will know, Jason moderated the previous session just before coffee, and Jason is a senior financial sector specialist at the Financial Stability Institute of the Bank for International Settlements. And in that capacity, Jason is responsible for disseminating guidance on sound practices for effective banking supervision. So with that, I'll invite Jason to give us his thoughts and questions and comments.
Mark, thanks. I think we heard two very interesting presentations that addressed somewhat similar issues from different perspectives, and allow me just a moment to remind everyone of some of the issues that were touched upon, and then maybe ask each of them a question. David started, and I think it was very apropos, by really introducing a human element to risk management. It's about people, it's about processes, and not about models. And David, for me personally, it's a very important point, because I think in this region in particular, we have a fair amount of what I'd like to call model risk. In other words, an over-reliance on the model. The model is always right, and we need to move away from that. You talked about understanding activities and products in the institution. You talked about communication. all of this happens by people, not by models. And I think that's important for us to take away. You encouraged us to think the unthinkable. Think outside of the box. The current economic crisis that we're all experiencing, I don't believe the stress tests and the models were capturing this. So we need to go further than we've gone before. Otherwise, we will not capture these types of scenarios. So David, my question to you is, how do we empower risk management? In the earlier session, Mark alluded a little bit to this. My opinion is that risk managers, they're not the deal makers. So they sit in the room and they may have the foresight, the knowledge, the experience to say, wait a minute, this deal doesn't fit within our risk profile. But risk managers aren't producing income, so oftentimes they get sidelined at in the interest of shareholders and a good return on the deal. So how do we empower risk managers and risk management so that they can stand up and say, this doesn't make sense? Now, think about that for a moment. Ming Soong, for you. I appreciated your comments about stress testing and the need to integrate the process. We can't just look at individual risk categories and add them up. That's not the way it works. You identified some areas of weakness, technology, data, experience, and so on. And I think both on the regulatory side and on the supervisory side, there are some initiatives that hopefully will address some of that. We'll see on the regulatory side some guidance coming out from the Basel Committee very soon on stress testing. You addressed regulatory initiatives and the need to strengthen the strategic role of risk management. And here is where I'd like to pose a question to you. And I think you have a very, very unique perspective for all of us here. You've been on both sides of the table. You were a regulator for a long time, and now you're a banker. Most of us here don't have that. So I'm looking forward to your comments. And it builds a little bit upon what Mark asked at the end of your presentation. So if we all agree that we don't want institutions to manage by regulatory requirements, and we hopefully agree that Pillar 1 is a minimum level of capital, whereas Pillar 2, in my mind, is an optimal level of capital. So how do we get institutions to move away from that thinking that, all right, I'm going to manage to the regulatory minimums? How do we get them to manage towards what's best practices, ideal for that particular institution? And then as part of that, I'd like to ask for your perspective on this ongoing debate of principles versus rules supervision. Given the current crisis, how do you think we're going to come out of that debate? So, David, maybe if I can ask you to respond first.
All right, I'm going to talk a little bit about how to empower risk management. I'm going to share with you some of my own experience when I joined the CICC. When I came for an interview, and people looked at my resume, basically they said, David, you haven't been doing risk management for the last like 80 years or 10 years. So why do you apply for a job of risk management? So my answer to them is, I say, risk management job is like a policeman. I say, sure, there's like a job is like a thief. I said, do you want a policeman or do you want a thief? So I think the first important thing is you have to communicate well with senior management. I think in my company in particular, I'm probably very fortunate. Like our senior management, put a lot of emphasis on risk management, and we keep a constant dialogue. And this is to me, I think it's very, very important. So how do you demonstrate the value you could add to the business? I understand that people, especially in Wall Street, a lot of time, you put emphasis on the positive side. And in the current crisis, I think this is like a typical example which demonstrates